those that are miles away from profits. What do you see in them? And can this really continue? And how do you find the next fever tree?
Okay, well, the first thing to say is that the vast majority of my long investments are very profitable and very, very cash generative. But value is always in the eye of the beholder. You just heard from Nick, he talked about, banks which are perennially seen as cheap shares, and they have significantly underperformed. So buying something because you think it's cheap does not equal long-term compounding success. Many people tell me my shares are expensive, and they've been telling me that for years. Yet these shares can compound their earnings, they can compound their returns, their market capitalizations multiply through time. If you pick on shares that you'll know, like Hargreaves Lansdowne, forever changed the DIY savings market for the UK. If you pick on phenomenally compelling differentiated industrials like Renishaw or Spirax Sarco, they have compounded their market capitalizations over 15 years because they do something that other companies just can't replicate. They can't be disturbed or undermined by low-cost, aggressive Asian competition. They have incredibly high barriers to entry because they solve customer solutions, they're well capitalized, they can finance that growth, and that gives them organic revenue growth far superior than their competitors. And that is why these great investments, which are always seen as expensive, can deliver and deliver and deliver. So I need people in the stock market to think of my shares as expensive on a 12-month view, really not appreciating and understanding what these companies can do over 3 years, 5 years and 10 years, because the wealth creation going forward will be led by these differentiated companies with unreplicable asset bases or companies driving vast swathes of disruption across industries.
Thank you, Dan. Chris, why has capital gearing taken such a defensive stance? Do you regret not taking advantage of the strong markets? Why do you love US debt right now and believe inflation is coming?
Oh, there's a lot of questions. Right. I suppose the first thing to say is that, we're trying to deliver absolute returns, and so at heart that means we're trying not to lose money. And so that inevitably means that we're going to be, just that much more defensive than other people. We go about it in a fairly boring, conventional way. We just try a mixture of cash, equities, bonds, a little bit of alternatives. And we try and sort of mix all of those together in a way where, we're really not going to lose too much money. And inevitably that means that we do underperform when a bull market is in full flight. Of course, with hindsight, we would have loved to have had, much more in equities, and we would have made much more money. But the reality was that by historical standards, even 4 years ago, most asset classes were expensive compared to their own history. And so we didn't feel that it was prudent to buy something that was expensive in the hope that it was going to get even more expensive, if that makes sense. Turning to the next question, why is it that we love US debt? Well, we love a very specific type of it at the moment. We've got 25% of our portfolio in TIPS, which are American inflation-linked bonds. And the reason for that is that as we look at the world today, we see that the world is grossly over-indebted, in our view, and that makes the financial system very fragile. And fundamentally, at heart, there is only one way to deal with the excess debt in the world, and that is something called financial repression. Now, financial repression is where central banks will keep interest rates substantially lower than the prevailing rate of inflation. Now, it could be that they keep interest rates at 3 and inflation is at 6, or you have inflation at 3 and they keep interest rates at 0. And if you do that for a long enough amount of time, you effectively rob the people who own the debt of the real value of that debt, and you get everything back into line again. And we're absolutely convinced that that is what is going to come. And in either of those scenarios, we'd expect inflation-linked bonds to do really well, and most other things to do pretty badly. And so that's why we have them there as our kind of anchor of our portfolio.
Right. And some fund managers focus on economics and politics first, sort of top-down approach, while others just pick stocks they like and think they can make money from bottom-up, which can affect how they approach asset classes, opportunities, sectors and geographies. Chris, I think your approach is different. You seem to adopt a top-down view. However, it's interesting that you specialise in a particular sector where you've had great returns, operating a sort of special sits investor in the investment company sector, which is very much bottom-up, which is probably more of the approach of Dan and Nick, which hopefully is fair. What do you think works best, and why do you do it? And I also notice your new funds are more top-down and suited to sort of unit trust.
Yeah, I mean, we have a pretty idiosyncratic investment process, and it's a bit like the tourist in rural Ireland who asks for directions to Dublin, and he's told, well, you know, you wouldn't start from here. But I guess it works for us, and so that's what we do. Our top-down approach is that we essentially try and look at every major asset class around the world and try and work out what the prospective returns are for that asset class, how risky it is, and then we try and mix them all together. So, you know, there might be on the one hand German residential property, it might be UK small cap, and then it might be, you know, American inflation-linked bonds. But then once we've made that decision, we actually go and look at the investment trust sector and see if we can find interesting opportunities to exploit. So let's say we've decided we want to have 3% of our money in UK small cap, and we go out and see if we can find a trust that's trading on a discount. Now, a discount by itself is not necessarily interesting, but if you've got reason to believe that you think that discount will close over time, then that can deliver you an extra return. And so that's how we ended up with this sort of curious mixture of top-down and bottom-up, and you know, it's well, it keeps us happy anyway.
Well, it's worked so far. Yeah. Moving on to people and management and skin on the game as a sort of investment strategy. Dan, the key to success of many high-growth businesses is their management team. They are the drive, the focus, and the glue to keep it together. You, Nick, I know you focus on incentives for management teams in financial, but how do you both go about factoring in people, their ownership, and their remuneration into your investment strategies?
Yeah, it's a great question, and it's one that comes up often in meetings. You know, how are management incentivized? How much skin, how much money do they have invested in that business? But within our remit, actually, that's a risk. You go back to the financial crisis, Bear Stearns and Lehman's. I mean, is there ever a management team that had more skin in the game? Both of those failed. So for us, it's understanding the business model, what risks that bank or that insurer is taking, and that's the key, you know, to us. Undoubtedly, management are incentivized, and it's very rare not to be. But for us, it's understanding that and the risks that bank is taking and how that will perform in a stress scenario.
Thank you.
Great. Well, I think what I'll do is I'll link the two questions. One is around how important management teams are, and two, why do I care about fundamentals or a bottom-up way of investing? So two things are closely interlinked. If I just pick on two shares to try and illustrate the point I'm going to make, Amazon and Fevertree. Okay, I'm sure everyone knows Amazon, I'm sure everyone knows Fevertree. Fevertree's probably gone up about 25 times in the last 4 years since it IPO'd. Amazon's gone up more times than I can think of. And what unites these two companies? Well, I'd start with the management team. I don't actually think Amazon would be anywhere near as successful and profitable as it is if it wasn't for the unwavering vision of its founder, Bezos, and more importantly, the depth and breadth of talent that he has built around him in that organisation. It's one thing having a vision, it's another thing executing it. I've met many, many CEOs of great visions, and then it's all the values being lost in the execution. Fevertree, again, an exceptionally differentiating, exciting consumer brand, obviously destroying the market share of its legacy incumbent Schweppes. But it's been driven by a management team that have prosecuted that long-term opportunity, and they haven't been beholden to short-termists in the stock market. So I think when you find great management teams with a great vision, with a differentiated product, they can compound that success through time. Just think in the last 4 years when Fevertree's gone up 25 times or Amazon's multiplied. You've had the Italian banking crisis. You've had a Brexit referendum, you've had a proletariat uprising in France, you've had trade wars, you've had concerns over hard landing in China, all these huge macro political events that dominate media, dominate market commentary, keep the economists from Goldman Sachs gainfully employed, but ultimately these shares have shrugged off all this nonsense and noise and have just delivered phenomenal wealth creation for clients.
Moving on to risk, there's so many ways of measuring risk which is coming out, which is obvious today. Diversification, hedging, leverage, price, volume, liquidity, dilution. There's just so many measures of increasing it and reducing it. Increasing risk generally should increase returns over the long run. It's the common phrase I hear a lot, but looking at capital gearing trusts over and impressive performance over 30 years, there's little evidence that this phrase is relevant. But however, breaking it down, there are so many factors to play with from an investment strategy point of view. Nick, I know you struggle to get exposure in the listed market to fintech. So therefore you have a position in Augmentum Investment Trust. Could you explain this, please?
Yeah, no, very happy. I mean, Dan obviously makes a very compelling case for investing in growth companies over value. We do both of that. Financial sector, that's much harder to find. So technology is having an immense impact on the banking and the insurance sector when you think of mobile phones, payments, etc. So we get exposure through this to things like MasterCard, Visa and so forth. But actually it's quite difficult outside those to get exposure to other startups, small interesting businesses. So one way we have accessed it, there's an investment trust called Augmentum FinTech. It's investing in some of these startups, Zopa, Iwaka, Interactive Investors, things like that. And it's a great way to get a diversified exposure to some of these, because you want to back the winners. The winners, as Dan was highlighting in some of these businesses, will make 5, 10, 15, 20 times your money, and you can offset the losses elsewhere. Whereas, having too much exposure to an individual one. So that's how we came to own that.
Okay. Keeping under the topic of risk, Dan, can you explain how you use CFDs in your portfolio to manage that?
Yes. The first thing I was going to say is actually we've got some common ground here, because in my hedge funds I also own Visa and MasterCard. So there you go, you've got a value guy and a growth guy, and there's some common ground with two exceptionally compelling long-term investments. In terms of using CFDs to manage risk, really there's two reasons for using CFDs, contract differences. Ultimately I can manipulate my net exposure to the stock market, so if I feel particularly bullish about the world I can be more net long than a traditional long-only fund. Also, if I'm more cautious about the world, like I am now, I can have a net exposure less than 100, so I can have less exposure than many funds. That helps protect clients' capital and reduce the volatility of returns over time. The second, and much more interesting and compelling reason, is I can short shares. And people like me can't sit here and just focus on companies that go up 10 times and 20 times. Particularly in the world of small mid-caps, as you all know, there are many companies that go horribly wrong. Two of my shorts last year went to zero, which is great for me because it's very profitable, but can be very, very disappointing or frustrating to those that actually own them. And unfortunately, there are many companies out there that can give small mid-caps a bad name. They have bad management teams, they have weak business models. They're being destroyed by regulation or through structural change, where they're just too commoditised. They've got far too much debt. They can't generate cash, and they sort of are very aggressive in their accounting treatments. And these companies are a problem for the stock market, and the advantage of having a fund or funds that can identify those opportunities and profit when they go wrong, I think is very compelling, and it really helps add to performance through time.
Okay, thank you, Dan. I know we're running short of time, so we've got to speed through. And I know, Dan, you own Xero, the accounting software business, yet this is yet to make a profit and trading on a high multiple sales. Why do you think that's attractive? And I also noticed you own Polar Capital, the asset manager. So what do you think?
Well, Xero has been an amazing investment. Xero is an absolute leader in accounting software. Created by an entrepreneur in New Zealand over 10 years ago. very disruptive. Ultimately, in the UK, in the US, the vast majority of small, medium enterprises are using spreadsheets to manage their accounts, which clearly is something that can change very, very quickly through time, through the provision of software that makes their lives easier. Hence, this company has seen annual recurring revenue growing at 45% per annum. Now, this is a very important year for it because this year is the first year it'll make a profit, okay? The price to earnings metric, i.e. value comes from profits, it's a great barometer of value, like 9 times in 10, but 1 times in 10 it is an absolutely useless, redundant metric. You never would have bought Amazon, you never would have bought Fevertree, you never would have bought Zero, you never would have bought Netflix, because sometimes companies have to scale quickly and they have to invest all their profits in creating that scale at speed to take market share. And so the key thing is not caring so much about what they valued on in 1 year, but how quickly cash flows materialise and grow over 3 years and 5 years and beyond. And that is the key in differentiating between those who sacrifice our near-term profits for growth and their ability to turn that profit and cash and see it inflect in the future. As for Polar Capital, asked Nick, but in a world where asset managers are consolidating and there's a stronger emphasis on just growing assets and pricing powers being eroded, Polar Capital is an incredibly attractive business model because it effectively has a platform that attracts star fund managers who contain pricing power, and generally they are more niche strategies focusing very much on alpha creation for clients, and they can keep diversifying that through time and really carry on seeing very profitable growth in the future.
In a couple of words, Nick, you could own Zero. Would you buy it now?
I think you've had the buy argument here. So we're spoiled for choice. We invest in the largest sector globally. Key for us is we're an income and growth vehicle. We have to balance that income requirement. Some of us need income.
Yeah. And Chris, imagine this isn't the sort of thing you'd look at, but I'd like to know when a stock is attractively valued?
Do you know, we really don't actually. So we never try and make an assessment as to whether an individual stock is expensive or cheap. What we try and do instead is look at a market as a whole and see if that is expensive or cheap. And the reality is that, you do come across kind of very talented individuals like these guys that are able to consistently pick winners. But those people are very few and far between. But actually, the things that go into what equities, say in the United States, are going to return over the next 10 years, that's pretty easy to understand. And so, we try and keep life easy for ourselves. So that would be a no from me.
Great. We are running out of time. I did want to ask a quick question and it's relating to Brexit, and it has to be asked. But given what's happening, if you were going to pick a stock or a fund other than your own, what would you pick for a hard Brexit and for a soft Remain outcome in literally just two words?
Okay, well, I'll go first. For hard Brexit, I'd expect sterling to fall. That's not a controversial view, and I'd expect interest rates to fall. So I would choose long-dated government bonds that are overseas. And for a soft Brexit, I would go for UK small and mid-cap.
Thank you. Dan?
A hard Brexit by the Frogmorton Investment Trust. Soft Brexit by the Frogmorton Investment Trust.
Hard Brexit, you obviously have to buy Chris's capital gearing trust, say a soft. Well, I'd agree, UK small mid-cap focused on domestic companies.
Well, thanks guys. Just in conclusion, I'm going to wrap up, we're running short of time, and I'd love to actually go on for ages because it's just the amount of expertise these guys have is phenomenal. In conclusion, the future is unknowable. I'm just going to give a couple of closing points which I think that hopefully I've extracted from this. In conclusion, the future is unknowable, but investing for the longer term helps, and diversification. Try and avoid losing money. If the value of your portfolio goes down by 50%, you need it to go up by 100% to get back to where you started. There is a lot of focus on interest rates, and interest rates are at rock bottom at the moment. That means More than ever, it's important to keep costs down, keep trading costs to a minimum, think about tax efficiency, ISA allowances, SIPs, junior ISAs, things like that. Even if we could identify what is one best thing to buy for the future, it will still give a bumpy ride. So will you psychologically be able to stay the course and stick with it? Look for champions who align with your lines of thought, and maybe those who don't. Place your money with people and companies and funds who have integrity, who you trust and have skin in the game. And finally, focus on things that you can control. Before I wind up today, just a little bit of PR on Quote's data, but it gives you tools and an extra layer of help on companies, investment companies, funds. So do use it, it's free, it's paid for by the industry. We have also written on funds managed by Dan, by Chris and Nick, which you can take away, and it's on our stand, and we have a selection of other recent notes, etc. Nick will be here after the talk, so if you have questions, do go and see him. Dan will be heading now to the auditorium, so I expect that will be very popular, so do follow him there. Chris has a third